Hi, today we are going to discuss the relevance of machine learning algorithms for market tradings and predictions. So we are trying to build our custom indicators based on machine learning models, and we are trying to improve our predictions and precisions for better trading profitability. And for this, we are going to consider the classic technical indicators, such as the RSI, the moving averages, the parabolic SAR, and so on. So any indicator you can think of can be fed to a machine learning model, and asking the model to bring us a prediction according to the values that we provided using all these technical indicators. At least this is the way I thought about it, like many years ago when I discovered machine learning. I thought I could feed any of those technical indicators to an intelligent model, which is the machine learning model, and with whatever data, the market can be predicted by the intelligent model. I believed so much in these models. Spoiler alert, I got somehow deceived by the challenges that you can face as a programmer when you are using machine learning models, especially in the Forex market and any financial market predictions. If I'm explaining all of this, it's that obviously I have tried using the classical technical indicators and I fed them to different types of machine learning models like regressors, classificators, nearest neighbors classificators, and so on. So all the supervised machine learning models for those who are aware and already working on machine learning. And definitely it didn't work. This is why I'm making this video, to show you where are the pitfalls of using machine learning in this intent. But then I thought, like, maybe along with classical technical indicators, which are lagging behind the market usually, we could use our custom signals that are somehow giving a good result. I have presented already in previous videos some strategies, and we already backtested these strategies, showing that the signals we have built are relevant to the market and they can give satisfying predictions and giving positive returns at the end of the year. So what if we put these signals along with other features and technical indicators for the machine learning model? Would it be possible to make an improvement on the results? So let's start with the code and see what this is all about. So first of all, as usual, we are importing our data. It's the Euro US dollars daily candlesticks going from 2003 up to 2021. I'm not going to spend much time on this. We have seen it plenty of times on this channel, on this playlist. So you can go back and check how we are using the data, how we are importing the data, and so on. Then I'm going to use the functions we have also introduced in the videos before regarding the support and resistance detection and detecting specific candlestick patterns or price action movements like the engulfing patterns, the shooting stars, and rejection patterns that are presented by the candles. All of these functions regarding the support resistance detection and the engulfing patterns and other rejection candlestick patterns were already presented in previous videos, embedded into a strategy which we backtested showing positive results. So we have positive returns using these specific functions into a different strategy. So I'm going to put 2 or 3 links to different videos where we explain these functions in detail. So if you are interested in these, you can watch them. However, we are not using machine learning in these videos. It's a classic passive strategy that works perfectly fine. So far, we are simply detecting support and resistance levels using the previously defined functions. And we are also taking into account the specific candlestick patterns, and we are building a signal out of all of these informations. So in other words, if we have a bearish engulfing pattern or a bearish candlestick pattern happening just around a resistance level, we expect the price to bounce down, and therefore we have a signal that is equal to 1. So 1 is equal to a sell signal, for example. And then if we have the opposite case, we have an engulfing pattern that is a bullish pattern, or a bullish rejection pattern happening just above a support level, we expect the price to bounce up from this particular level, and therefore our signal will be equal to 2. If we don't have any of these, we have a signal equal to 0. So this is what we introduced as a new indicator to our machine learning model in here. And since this signal was already tested in a strategy, as I've said before, and this strategy showed positive returns, It means that the signal is capable of predicting somehow the market direction, the future market direction. The difference between this signal, which is a custom signal, by the way, as you can see, and the classical technical indicators is that the classical technical indicators, they are lagging behind the market. So you can't build a moving average until you have a price already. You can't build, for example, an RSI for today's until the day price is closed. So it's somehow the signal value is coming lagging behind the price, the actual price movements. And this is the main handicap of technical indicators. However, in this case, it's a signal that is trying to predict the future based on some mathematical behaviors, for example. And the idea here is that what if we fed this signal to a machine learning model? Would it make any improvement to the model? Would it bring something that is powerful for the machine learning model? So we are testing our signal. For the moment, in all our data, we have 81 buying signals in total, and we have around 84 selling signals. This is the daily data. You might have more signals if you use lower time frames like the 4 hours bar charts or the hourly bars charts. I'm using the daily data because this is where our strategy worked with positive returns. So if we continue now, this is still part of the previous video where we built our signal and we back-tested our strategy using some take profit and stop loss ratios based on the signal behavior. So back-testing this signal provided us 126% in returns over around, I think, 20 years or 18 years. So it's something around 8 to 10% per year. Most importantly, it's valid signal. It's positive. The returns are positive. And so we are going to use it to feed it to a machine learning model. To be able to build or train a machine learning model that is a supervised model, we have to have the target, meaning the result for many trades. And this is where we are building this target column, which is our trade result somehow. So I'm taking a pip difference of 250 pips, for example, as a take profit distance. And then we can have a stop loss take profit ratio that is equal to 1. So I'm taking equal distances for take profits and stop loss as a first attempt. Then for every candle, we're going to look a certain number of bars up front to the front in the future and check if the price is going up or down by that much. Is it going to touch the stop loss first or the take profit first? And in both cases, we are going to sign it as 1 if it's a downtrend. I mean, if it's touching the minus 250 pips first. 2 if it's an uptrend, meaning if looking up front from a particular candle, we're going to touch plus 250 pips first before touching the minus 250 pips. And if we are not touching anything, I mean, if the price is going between plus or minus 250 pips, we have no clear trend, in which case we return 0. So the result here will be dependent on how many bars in the future you are looking for. And it's going to depend also on the distance of your take profit and your stop loss values. And at this point, we have to use this function. Remember, it's a function called myTarget, and we can use it on a data frame. And I'm looking 10 days in the future to see what can this strategy give me. And this is where we have our first challenge building our data for a machine learning model. How many days are we going to look in the future to keep our trades opened? And the reason it's challenging, I'm going to build a histogram with the 3 different categories: downtrend, uptrend, and no clear trend, depending on this value here, like 10 days. As you can see, we have the maximum actually is reached by the 0 category, meaning no clear trend. Then we have the downtrend is around half of it, like we have 1,000 cases. And then the uptrend is also around 1,000 and something. So in other words, this is a challenge because if my machine learning chooses to return 0 as a result, like we have no clear trend, in this case, the precision of my machine learning model is 50%, because half of the cases, if the machine learning model is simply returning 0 all the time, not trying to predict anything, half of the cases are going to be correct. So the precision is 50% with a very stupid model. And notice how this is going to change and will be affected by the number of days. I'm going to take 15 days up front. And now the ratios are different. We are almost at the same frequencies for the 3 different categories. We have less downtrend because this is the nature of the market, but however, there is no preferred category in this case. So this is where you have to be very careful what you are choosing. And it's also affected by the take profit stop loss distance that we are considering. Imagine I'm raising this from 250 pips to 450 pips. I'm going to run this function, and for the same 15 days, I'm going to run it again here. We have 0 category dominating everything again. So again, if my model is going to predict 0 for all the trades, in this case, in 90 or 80% of the times, it's going to be correct. However, it's a very stupid idea. It's true, it's 80% precision. However, we're not detecting anything useful here. I mean, 0 category is no trend category, and I can't take a decision of buying or selling. What I'm interested in is the precision on predicting these 2 categories, 1 and 2. I'm not interested in the precision of the 0 category in this case. So what do we do in this case? The best we can do is to choose a setup where we have almost the same frequencies for the 3 different categories, or a bit less for the 0 category. So I'm going to increase, first of all, I'm going to decrease the take profit stop loss ratio. Let's try 350 pips here. And then let's try 30 days, because we can keep our trade open up to 1 month, let's say. And this is what we are getting here. So I think we have to shrink our take profit stop loss distance again. This here is better. In most of the cases, we have a price touching either a downtrend or an uptrend. The cases where we are wobbling between take profits and stop losses are very minimal regarding the historical histogram. And for the moment, I'm going to keep this as is. So we're going to consider 30 days in the future. Our take profit stop loss distance is 250 pips. It's equal distance. Stop loss take profit ratio is 1. Both distances are the same. Let's check it out. If we can find a model prediction that is higher than 50%, then we can consider it's good. If it's higher than 50% for these guys, for category 1 and 2, then it's perfect. We have found a winning machine learning model. Let's continue and see what we can do. So as an example in this video, we're going to consider the RSI along with the signal that we have already backtested in a passive classical strategy. And we found out that it gave positive results. The model's input will be the signal and the RSI, and the target is going to be this target column here. Now, as you may have noticed, we have weird values for few rows. This is completely normal, because if you're trying to build an RSI value and you need, let's say, 16 historical candles, if you don't have them at the beginning of the data frame, you cannot do the computation at this point. So you need at least 16 candles. So starting from our 16th or 17th candle, we have enough data to build the RSI. And same thing for the target, because we are looking for the future and we are looking 30 candles in the future. The tail, if I plot the tail of my data frame, it's going to be anything below 30 is going to be none also for the target, because we need at least 30 candles in the future to predict if it's an uptrend or a downtrend. This is the way we built our code. So to clean this, these weird values from our data frame, we're going simply to drop the NA rows at the beginning and at the end of our data frame. We're going to reset the index, and we're going to print a description of our data frame to make sure that the counts in all the columns are the same, so we don't have any weird values in our data frame. Now, one thing we should pay attention to is that our signal that we have computed, the signal column, should be a categorical variable for machine learning models. This is crucially important. We can't leave it as a single column showing 0, 1, and 2. The models cannot understand this. Since 0 is less than 1 and 1 is less than 2, the model is going to think that there is some kind of relationship, because we have increasing values from one row to another. Although this is not true. So we have 3 different categories. The downtrend is no less than the uptrend, and the uptrend is not greater than the no trend at all, which category is 0. So these are simply 3 different categories, A, B, and C. There is no order between these categories. And when it's the case, we have to do something called one-hot encoding for this particular column before feeding it to the machine learning model. And by this, we mean that we are going to split our signal column into 3 different columns. I call these signal category 0, signal category 1, and signal category 2. And as you can see, you have 1 and 0 in each signal category. So when is the signal equal to 0, we're going to mark 1 for these rows, and it's going to be equal to 0 for the other rows. When the signal category is 1, we have a downtrend, we're going to have something equal to 1 in these rows and 0. So in other words, any of these rows can only take 2 values, either 0 or 1, and you can have only one signal equal to 1 per row. We can't have 1 in both rows because a signal cannot be equal to 0 and 1. A signal cannot be equal to 0 and 1 at the same time, or equal to 1 and 2 at the same time. So we have one signal for each row. There's an easy way of doing this by using few functions from pandas, get_dummies. But first, let's define a new data frame on which we are going to train our machine learning model and use for the testing procedure also. So I'm going to declare the attributes list, which is going to be the RSI, the signal, and the target. We don't need anything else. It would be a huge mistake if you include the opening, the closing, a high, and the low prices. These are meaningless in this case. What is relevant are all the relative values or the relative variables that you can introduce for the model. For example, the RSI, the signal, and obviously we need the target to know what are we talking about. Is it an uptrend, downtrend, and so on, just to be able to train and test the model. At this moment, we're going to define something called DataFrame_model, which is equal to the attributes from the data frame.copy, because I need a copy of the data frame. And we are going to transform the signal column from the df_model data frame into a categorical type. So we need first to cast it into a category. It's not an integer, it's not a float, although these are numbers, 0, 1, and 2, but we need them to be a category. And then I'm going to define a variable called df_dummies, let's say, in which I'm going to store the result of get_dummies of df signal. And this is the function that's going to do the one-hot encoding. It's going to split it into 3 different columns, just as we have explained. And we need to provide the prefix for each column. So it's going to be, let's say, signal category. And the function is going to add the _0, _1, and _2 in this case. So in other words, the function goes through the signal column. It reads how many categories we have in there. It's going to split or create as many different columns and do the whole procedure for us. It will do everything automatically, so we don't have to do the one-hot encoding manually. And at this point, the signal column is useless for now because we have split it into 3 different columns. So we're going to drop it from our df_model. And we're going to concatenate the df_dummies, these 3 different columns, into our df_model. So we have what we already had in df_model plus the df_dummies columns. And this is what we get. This is our df model now. We have the RSI, the target, and the 3 different signal categories. Now I'm going to use the X gradient boosting classifier. The reason I chose this is that it's the most powerful and the most efficient classification algorithm in machine learning so far. Out of experience, I checked it out. I checked on the web. I also used it in many different applications, and it really provides very efficient results, very good results. So we're going to define our attributes. We have the RSI, the 3 different categories, and the X, what we are going to feed, the features that are going to be fed for the model are these particular attributes. Then the target is going to be the column called target. Is it an uptrend, downtrend, or no trend at all? Then we're going to split our data into 70% for training and 30% for testing. And we don't do it in a random way. This is also another pitfall in machine learning. I've already explained why it shouldn't be done in a previous video. I'm going to put a link down in the description. However, just in brief, if you are randomly choosing using the train test split function, what we usually use in the machine learning splitting is that the random sampling is going to choose candles that are neighboring to the training candles. So in one way, you are choosing a random candle to use it for training, but from the other side, the candle that is just next to it is left for the testing. So these two candles are very similar. In other words, you are training the model on something that is very similar to the testing candles. And it's going to give you false, very nice results. However, it doesn't work in real life. The correct way to do this, we split it by using a simple slicing technique. The first 70% of the data is for training, and the remaining 30%, since it's a time series, are left for the testing part. So now we are going to do this. This is done here, and it's a simple slicing, as you can see. And then we are going to define the model, which is the X gradient boost classifier. We're going to fit the model using the X train and the Y train. Remember that X train contains all of these. So it's 4 columns in total. And Y train, the training Y, the target is only 1 column, which is this one. Definitely the rows are different. We kept 70 and 30% between training and testing. However, the columns names are these and this one, the target. After fitting the model, we're going to define the predicted training target. So I'm going to call predict from model, so model.predict, and I'm going to feed it with the X train. And also I'm going to predict something from the testing data set, the remaining 30%, feeding the X underscore test data. The reason I'm doing both, trying to repredict the training data set and also trying to predict the test set, is to be able to compare both precisions, on the training and the test set predictions. So the comparison is going to give me an idea if I'm overfitting and if the predictions are somehow relevant or not. Then to have the accuracy score, we're going to compare the Y train and the predicted training set target, and then the Y test and the predicted test set target. And so these are our results. Actually, we are predicting the training set. First, we are fitting our model on the training set. Then I'm re-asking the model to try and predict the target on the training set. And it's providing me something around 57%. Then for the test results, we have 32% of accuracy. So this is, first of all, this is very bad. You can't win a trade with 32% of accuracy. The second remark is that these 32%, we don't know how they are divided between the different categories. It's a global classification result between the 0, 1, and 2 category. However, the 0 category predictions are not going to do me any good because I can't trade using the 0 or the no trend predictions. I'm mostly interested in the category 1 and category 2. So in order to go more into depth in the analysis, let's try and check the confusion matrices and try to check the classification reports for this model. For the training set, we can see that the precision on the 0 category is 0 because simply the model is not predicting anything for this particular category. It's the least frequent category. Remember our histogram. If I go back up, we chose values that gave us the least frequency for this particular category. So our model is discarding it from its predictions at some point. And that's fine. This is why we reduced the categories frequency. Okay, it's not perfect, but we can skip it because we're not interested in this particular category. Now let's see what's happening with the selling trends. So the downtrends are predicted within the 68% precision. Remember, this is the training set. We are mostly interested in the test set, which is this one. We're going to come to this after checking the training set. So for the training set, we have a precision of 0.68, 68%, and a recall of 33%, meaning we are only detecting 33% of the cases that are present in the data. We're not very sensitive as a model, but we are precise for the downtrend. Overall, the F1 score that englobes precision and recall at the same time is 0.44. At some point, we have to sacrifice the recall in trading. You can't detect every single opportunity on the market. This is impossible. If you have something around 20 to 30%, it's okay. But the most important is the precision, that when you detect something, it should be a true positive. It should be a case where you are predicting correctly the direction of the trend. So to go to category 2, which is the buying category, the uptrend category, we have 0.54 as a precision. So 54% of our predictions are correct. So this is not bad. And we have a very sensitive model to buying categories. So it's 89% of the cases are detected from the market. This is huge. So remember, this is the training set. The model already knows the market. We've already fed the target for these for this data. Let's check what it is for the test set. So again, for the 0 category, we have nothing. It seems that the model doesn't like this category. It's discarding it somehow. For the selling or the downtrend, we have a precision of 28%. That's not very good for trading. Taking into account that we consider the take profit and the stop loss values at equal distances, we need something that is greater than 50% to be able to trade. Anyway, we have 28% here. The recall is 0.18, so it's not much either. We're not very sensitive. We are missing most of the opportunities in the market. And an F1 score of 0.22, which is not very good either. So our model is not very performant for selling for the downtrends. Now for the buying, when we have an uptrend, it seems that it's giving better results. We have a precision of 0.33, so 33%. We have a recall of 0.77. This is huge. It means that we are detecting 0.77 of the market's uptrends. Let me check if this is the most frequent category in our histogram. Yes. This is why. Actually, this is convenient here to explain. We have one category that is the most frequent category on the market. And this is the pitfall of machine learning. This is the most frustrating part, that the model is going to act sometimes in a very stupid way. I'm sorry about this, but it's going to predict most of the times that we have category number 2 because it can see that this is the most frequent category in our data. So in other words, if the model falls into the trap of predicting one category for all the presented data, it's going to be correct for, let's say, at least 30 or 50% of the times. Okay, because we have 3 different categories, and you can see this is the most frequent category. So you can build a model that detects simply 2 all the time, and it's going to be correct in this case, in most of the cases. What we can conclude is that it's not working properly. This is not good for trading. You can't trade with these percentages here. Now, there might be different ways of doing this. I assume that if we present the model to predict only one category, let's say we build a model for buying only, and we build a different model that we train only for selling positions, it must work in a better way. The more data you feed, the more stuff you ask from your model, like if you have 3 categories or 7 or 8 categories, it's going to be harder to predict. The less categories, the better. So in this case, I think the best way is to rebuild a whole program, fit a model just to predict buying positions, and then fit a different model in a different program trying to predict when do we have selling positions. We might have higher chances of success in this case. Now, I have added something on top of it at the end of this program just to check the importance of the different features that we are using for the model. And if you can see here, the RSI is considered much more important than our signal categories, which is weird because with a passive strategy, In a previous video, we could predict the market in a very good way, even better than using the RSI. However, the model here, the machine learning model, is preferring the RSI for some reason. You might want to add different technical indicators. I did receive comments telling me to add, let's say, 50 different technical indicators, or all the different technical indicators you can find on any platform. Now, this doesn't work. The more technical indicators you put, the more features you feed your model with, it's not going to be beneficial. Actually, it's going to make the model more complex and less performant. So the least you can provide is the better. However, there's some kind of an optimal number of features for each case. And in our case, you have to have the time to try a very wide range of combinations between the RSI, the SAR, parabolic SAR, the moving averages, slopes, and maybe the moving average convergence and divergence, and so on and so on. So as you can see, it's a very tedious task. And this is one of the reasons why most of the videos I'm presenting on the channel now are deviating away from machine learning. Okay, so that would be it for this video. I hope you guys liked it. I hope the information is helpful for you, for your trading. If you are still watching, it means you are very patient. Thank you for staying that long. Sorry for the long video. It's very hard to put all these informations into a short video. Please don't forget, if you have a second, to like, subscribe, and maybe leave a comment if you have new ideas. Until our next video, safe trading and see you next time.